We had a little bit of a sell-off on Wall Street today with the S&P 500 closing just below the break-even point. But sometimes there's more than meets the eye, and in tonight's video I'm going to show you how to look at the market from a slightly different perspective using different breadth measures and looking at things from an equal weighted versus a market cap weighted basis, and you might actually have a slightly different takeaway after seeing that information. In addition to that, we're going to take a look at what happened with interest rates today and some of the big movements that it caused within the bond market. And then we're going to get into our trade application example, where I wanted to focus on one of only 3 sectors that currently has a bearish posture and do what's known as a bear call spread on one of the components from the internet space there. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's August 11th, 2022. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into our description area. Make sure you're signed up for our email distribution list, so that way you can be notified whenever we post these videos. Remember, at the bottom of those emails, we'll also let you know which stocks are giving you overbought or oversold cluster signals within the S&P 500. In addition to that, we're heavy users of Twitter. If you're not doing so already, I would encourage you to follow me at Brandon Van Zee. We really appreciate those of you that click like and retweet on these Market Outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And here is our heat map for the S&P 500. And as you can see, it appears that there's more red on the screen right now, but could this be an optical illusion? As you know, I'm probably leading the jury there, and the answer is yes. Despite the S&P 500 being down today, not by much, but down just a touch below break even, there were actually more stocks up in the S&P 500 than down today. It just doesn't really appear that way to your eye right now because, of course, this heat map here shows us the squares in a market cap weighted context, and therefore the larger the company, the larger the square. And it just so happened to be that today was one of those days where the largest companies seemed to end up on the losing side of the coin, and most of the smaller companies ended up performing just fine. And so let's go through those and investigate a little bit further. You can see that Apple was down about 0.5% today. Microsoft was down about 0.75% today. Amazon was down about 1.44% today. Remember, we've got a bear call spread on that one right now. We've got Tesla that was down 2.6% today. And then we do have Alphabet down here, down about 0.69% here today. So those are the big players in the S&P 500 these days, as they are the ones with the largest market caps, and all of them finished there easily in the red. Now, when you look for where we did find more green showing up here today, you'll notice that we had a very consistent day out of the energy patch. It kind of feels like energy is one of those areas that the moment you give up on it is the moment that it flies right back higher. It kind of feels like it's more 2 steps backwards, 1 step forward type of a thing. But you can see here all of the energy stocks were up today as far as I can tell. So let's go ahead and zoom in here. And yeah, not only were all of them up today, but they were all up pretty nicely. Those are some pretty bright green squares that we're seeing there. Almost all of these, from what I can tell, were up more than 1% here today. Best performer was Devon Energy. It's actually one of the stocks we currently hold in our top-down trend trading class, so we were happy about that. Happens to be a high-yielding company these days as well, as a result of their variable dividend yield policy that they have over there. But regardless, you can see here that it was a clean sweep here in the energy patch today. Moving back towards the normal the normal S&P 500 view, you can see another area that to my eye held up a bit better seems to be financials. So let's right click there and kind of zoom in on the financials, and you can see that most of these were green. Not all of them, like energy, but the vast majority of financials were green today. And that's not something that's just a one-day occurrence. It seems like here in the last 3 days, the financials have had a little bit of outperformance, and that's worth noting because previous to that, that really had not been the case. The financials had been laggards up until then, but it seems like when that CPI number came out the other day, financials had started off a nice little bout of outperformance there. So let's keep our eye on that trend in motion as it stands right now. But as you can see here, Schwab was the biggest winner from the financials perspective. It appears up nearly 4% right there. But a lot of your big banks were up here today as well. Even a lot of your insurance companies and credit card companies were all up here today. So strong performance there out of a lot of those financials. Now, for those of you that attend my Wednesday morning factor-based swing trading class, you'll know that there are two sectors that I regularly refer to when we talk about the value factor, and it just so happens those two sectors are energy and financials. And so today was probably a day that not just from a sector perspective, but from a factor perspective, value probably outperformed growth here today. Those are some of the areas that kind of perked up on a more consistent basis. In terms of one of the more important players out there today, Disney, of course, comes to mind. Disney reported their earnings after the bell yesterday. For those of you who are Disney Plus subscribers, expect your bill to go up here in coming months unless you opt to go with their new expected advertising tier, which was different than in the past with their streaming service mostly being non-advertising. And so there's change afoot there, kind of following in the footsteps of what we're expecting out of Netflix as well. But Disney has been beaten to a pulp this year, trading as low as about $90 per share just a month or so ago. It's back up to about $117 after today's move higher, but still has a long ways to go before it's back to all-time highs there. Another stock that's doing pretty well that I just got done tweeting about here a couple of moments ago is Cardinal Health. Cardinal Health was up 5% today. It closed exactly at $66, which happens to be exactly a 3% dividend yield. This is a dividend aristocrat that had been kind of out of favor, quite frankly, for the last, let's call it 5 years or so. And we've been kind of trying to stay patient with it as DGI practitioners over time, and it's been a little bit more difficult as we've watched a lot of other areas of the market go up nicely. Well, that particular stock really had not been, but all of a sudden we are now at multi-year highs on Cardinal. We're still not back to all-time highs. That was set several years ago, but we are here currently today at our highest level in the last 4 or 5 years there. And so we'll see if that can continue its mojo or not. From what I understand, not only did they report earnings here today, but they also had a change in the CEO role. And so maybe that is spurring on some additional buying from the marketplace. Maybe the expectation being that the company could be put up for sale, right? Sometimes that happens when a CEO leaves and the stock goes up that day. Sometimes the market interprets that as a potential for the company to be bought out or perhaps change course. So we'll see. We'll keep our eye on that story, but just thought I would mention it since I just so happened to be tweeting about that a second ago using our dividend stair-step chart. So all in all, it was a day where the mega cap tech focus types of companies did close in the red, which did cause the overall S&P 500 to close a bit lower. But it was also a day where we had most of the smaller companies actually close higher here today. We had a clean sweep in the energy patch, and the financials looked awfully strong here today on the whole. Let's go ahead and now pop on over here and check out our market breadth on the main part of the platform. And you can see that today, 296 stocks in the S&P 500 closed higher today. Despite the market being down today, we had way more than half of the stocks closing up, right? That's about a 59% hit rate to the upside. So that is somewhat rare, right? When the market is down, you expect most stocks within the market to be down. Today, that was not the case. Today, we easily had more winners than losers, yet the overall S&P 500 still closed in the red. Over here on the charts now, just to prove my point a little bit further, again up here in the upper left, you see S&P 500 pulled up on chart 4B, and you can see it was down 0.07% today. So again, I don't want to make too much of this because it was basically a flat day. But nonetheless, it was down just a touch. You can see an obvious red candle right there. If I were to right-click and maximize the sell, you can see that that candle is red, and it was filled in red, meaning that you kind of gapped up to start the day, you pushed to new multi-month highs on an intraday basis, and then you effectively gave back all of those gains and closed very close to the lows of the day. Not a great look a day after what should have been a very promising breakout day for the S&P 500. So again, it was a down day for SPX, but check this out. If I pull up RSP, So Ralph, Sam, Paul is the ticker symbol there. Check out how RSP was actually up nearly 0.5% today. That's a pretty good move for RSP. And all RSP is an ETF that is an equal weighted S&P 500 tracking instrument. So again, proving the point that today was kind of being clouded and maybe somewhat misinterpreted by the fact that a select group of mega cap companies closed in the red. But on the whole, we actually saw reasonably good breadth measures out there if you were to kind of advance your thoughts beyond just the mega cap tech focused companies and move down the chain a bit. Most of the mid cap and small cap stocks actually closed in the green. And when you look at it on an equal weighted basis, we had a reasonably healthy advance. Now, you still have the shape of the candle that's a concern, so I don't want to make it seem like, hey, this is a home run and this is a great look for it, because it's not. We still have a long upper shadow here, but it's just that we didn't give back all of the gains of the day. We still had a healthy advance when it was all said and done there on RSP. So wanted to share that with you because it's pretty unique. Definitely caught my eye, and some of you might not have been aware of that if all you're doing is looking at the S&P 500. But today was one of those rare days where that does occur every so often. So let's now take a look at our postures using the market forecast system. Remember, unless stated otherwise, when we reference our posture using the market forecast, what we're really talking about is the green intermediate line underneath these four charts here. And as it stands right now, we continue to have strongly bullish postures across all four of the key U.S. equity indices. We know that right out of the gate, and those of you that follow this presentation will know that right out of the gate easily because you can just look at the background color of the chart. And so that helps even those of you who are watching this on a, let's say, a smartphone where your screen size isn't quite as big as the desktop monitor that I'm broadcasting from right now. All you have to do is look at the background color of the chart that is kind of surrounding the most recent candle, and if it is dark green as it is right now, that signifies that we do have a continued strongly bullish posture according to the intermediate line on the market forecast. Now, obviously, that particular line is not the end-all be-all. Eventually, that will transition to more bearish postures, and there's plenty of times where it gives you head fakes, and there's plenty of pitfalls with it, just like there is with any technical indicator that's out there. So that should not come as a surprise to anyone. But for right now, it is giving us a consistent message. And that message has been, you would have been better off being long the stock market for the last month than short it. And I bet there's a lot of people out there, hopefully not too many of you listening, but I'm sure there's a lot of people out there that did not heed that message. I get the sense that we are currently in the midst of a pretty rapid recovery in the stock market where a lot of people on the short side of the equation are feeling quite pinched right now. Some of you saw that I was tweeting about a stock earlier today that was up literally triple yesterday. It was up like 200 to 300% somewhere in there. And then today was back down 50%. So we are seeing some incredibly volatile moves out there. But if you happen to be shorting the wrong stock at the wrong time, you can get absolutely massacred in this market. But what the posture setting system has told us is that since this day right here, July 19th, we have consistently had a bullish posture using that posture setting system. So that could have been a time when you said, okay, doesn't feel good to shut down my bearish trades right here because you might have had to take losses. But I'll tell you what, looking back in hindsight, I'm sure you would have been much happier taking a small loss here on your bearish trades than a really large loss if you're considering doing so now. So, again, not to infer that the market forecast is a perfect system or anything like that, but can it work? Does it do a reasonable job of helping you stay on the right side of the market? I would say it does a reasonable job, just as good a job as anything else. And so that's one of the unique aspects that David and I provide you here during these daily free market outlook videos that you can find on YouTube. So add it to your toolbox, so to speak. Obviously, there's tons of content and education out there, and I'm sure you guys watch lots of other YouTube videos and things like that as well. And all we ask is just keep an open mind, add what we're saying to everything else that you're learning, and hopefully you'll end up with better outcomes the more knowledgeable and educated you become. Anyway, with today, we now have not only strongly bullish intermediate postures across the board, but we continue to have a 30-day moving average that is painted in green on all 4 of these charts as well, telling us that price remains above a rising 30-day moving average, which in other words means that the path of least resistance continues to be to the upside. Regardless of what you think about inflation, the economy, Jerome Powell, who's in the Oval Office at any given time, who used to be in the Oval Office, none of that really matters. What matters is what's staring you right in the face right now, and the trend is bullish at this moment. And we recognize that, and we also recognize the possibility it can change. And when it does, we'll be the first to tell you about that. But for right now, if you're trying to trade what you see, there is more of a healthy look towards the bulls than the bears at this moment in time. I'm sure David shared this with you when he did the video yesterday, but as I alluded to a little bit ago, we did have a healthy breakout yesterday, and we got well above those prior resistance areas there on the S&P 500, and so I think that's a good sign. You can also see that one thing that brings all 4 of these charts together today is that we do have our high labels on today's candle on all 4 of those charts. Now notice that there is not an additional high label that shows up here in green on the labels themselves. So what I'm referencing there is this line atop of the charts. I'm not talking about this gray label right here on the candle. I'm saying this line up here where we've got some of these other performance numbers and what have you. Like if I were to pull up Kellogg here today, check this out. Kellogg, ticker symbol K, has this additional label there that says the yearly high was today. So Kellogg, of course, doing quite well. But the S&P 500, Dow Jones, NASDAQ Composite, and Russell 2000 still have a long ways to go before they are at new 52-week highs and all-time highs. So these high labels that you see on top of today's candles basically reference that these are the highs for the last 3 months of the chart that we're looking at right here, which is a start, right? If we're eventually going to get back to all-time highs, then you got to start somewhere. And just because you can't get to 52-week highs immediately doesn't mean you can't start by getting to 3-month highs. And that's where we stand right now on all 4 of these charts. And all else being equal, that's a very bullish sign. That's not bearish, right? It's not bearish when you're breaking to 3-month highs. It is considered more bullish. And is it perfect? No. As I mentioned before, we've got those long upper shadows that came with today's trade. We've had such a persistent move higher off of the lows in the last month and a half that naturally you've got to expect that there will be some sort of a pullback in the short term. Markets don't go up every single day. But the question is, will it kind of upend the infant trend that we have to the upside? And usually the mindset of a technician is the trend is your friend until the end, and eventually it will end, and you will know when it does, when it starts breaking through key support areas like moving averages and things like that. So right now, regardless of what you think about the economy and all that kind of stuff, just trust your eyes, and your eyes are showing you that the trends are bullish at this moment in time. The other thing that I would point out is that we do have a bullish intermediate confirmation signal today on the NASDAQ. Now remember, the last time I was with you on Tuesday, we also had this conversation because on that day we had bullish intermediate confirmation signals on all of our charts. Now imagine some of you buying the market on Tuesday as a result of those bullish intermediate confirmation signals and then watching the market rip higher for one of its biggest days in quite some time yesterday, right? The markets were up 2% plus across the board. So that particular bullish intermediate confirmation signal on Tuesday worked like a charm. Well, this one, hard to say. Always leave you guessing, I suppose. But what I would say is, remember on Tuesday how I was breaking down those various intermediate confirmation signals for you and reminding you that 2 of them looked like they had the more idealized form and 2 of them were less ideal. The 2 that looked better from that perspective were the S&P 500 and the NASDAQ Composite, because on that day, not only did you have the green line in the upper reversal zone, red line in the lower reversal zone, but you had the blue line between 20 and 50, right? You had that for the S&P 500. You had that also for the NASDAQ Composite. But on these other 2 charts, you didn't have that set up. So those ones wouldn't have been as trustworthy. They would have worked out just fine, but just pointing out the differences there, because when I talk about today's bullish intermediate confirmation signal on the NASDAQ composite, notice that you have the green line in the bullish territory in the upper reversal zone combined with the red line in the lower reversal zone. So that constitutes an official bullish intermediate confirmation signal. But the problem is, if we were going to use that blue line to try to determine if it was a more ideal or less ideal setup, we would consider this one today to be less ideal, because that blue line is way up here at 78. It is not between 50 and 20. So there hasn't been a real healthy give back, right? A couple of days ago, I was talking to you about how we had just, had 3 days in a row of sell-off for the NASDAQ, and we actually had 4 days in a row of sell-off for the S&P 500. So fast forward to where we're at right now, we only have 1 day down, which is today, for the NASDAQ, and therefore it's not a real great buy the dip signal. Nonetheless, it exists, so I figured I better at least let you know about it here in this video. All right, let's go ahead and pop on over to the internet briefly. I always like to get a chance to say thank you to all of you who help support this free presentation. Remember, these recordings take a lot of time for David and I. A minimum of 3 hours goes into it, and of course we don't make a dime doing it, and so we really have to ask ourselves whether it's worth our time and whether we can justify giving up our hours out of our day to do the videos. As long as you guys are willing to help support them, then we are more motivated to do them. If you're not willing to support them, then our motivation isn't quite as high either. So we're always doing our best as business owners to try to kind of feel that out and provide that balance out there, as of course we want to get the word out about our business and help educate you, but at the same time we have to be honest with ourselves as to how much time it takes us to do these videos. So as I always say, as long as we're up and over 100 likes on Twitter, I'm happy to do a full-length video that includes a trade application example. If we're under 100 likes, then it's kind of sending the message that you guys aren't getting quite as much value out of these videos anymore, and therefore it's okay for me to put a little bit less effort into it, because if I don't have to come up with a trade application example, that's going to shave probably 45 minutes right off of that time period right out of the gate, because I spend quite a bit of time looking for those on the charts ahead of time. So anyway, if you want me to keep on doing what I've been doing, then just keep on clicking like. It's pretty easy for you. Nice little trade-off there. It only takes 5 seconds out of your time to access the 3 hours out of my day. So quick little shout out to some of you that helped support us the last time around. Thank you to Brandon Walker and Violina Santu and Irene Zing and Roger Holder and Ram and Phil Van Ostrand and Sheila Lafade, Paul Maloney, Roger, and others. Coming down here to the bottom, we've got Michelle Addy, we've got Thomas Nixon, there's Claire Lee, there's Walt Puba, we've got Nietzsche, we've got Trunk, we've got Curdy, there's David Settle, I know him, Keola Ing, we got Lucius Allen, and William Tonseth, Serene Lee, Topline Invest, Tom Smith, and others. Thank you very much. Can't get to all of you, but I always like to give you a few shout outs here and there, because I know it does take a minor effort on your part to do that, and I want to recognize that. So thank you very much. Keep up the great work on your side of the coin as well. Let's come on over here now and take a look at what's been going on with the factor selector. As you can see, this is as of August 9th, so it's a couple of days stale by this point. I usually put this together in advance of my Wednesday morning factor-based swing trading class. And you can see for the second straight week, we had low size leading the way. Now remember, low size is a bit more of a speculative factor, and so that makes sense with the markets rallying pretty furiously. Since the end of June, we've seen more of the speculative factors kind of perking up a little bit there. We also saw momentum make a move higher up into the number 3 position here this week. On the flip side, some of those areas that were working really well before, like value and dividend yield, remember those were our leaders early on in 2022, they've now given way to more of those speculative areas. And so on a relative basis, value and dividend yield have fallen to the bottom of the heap here, as those are areas that investors tend to seek out when there's more fear in the marketplace and we're in more of a risk-off type of a marketplace. Right now, you'd categorize what we're dealing with as a risk-on market, and therefore it makes sense that the smaller companies and the momentum stocks are doing a little bit better. And remember, quality these days has the biggest allocation towards technology stocks. So I know that's a little bit of a maybe a misnomer for some people, because they tend to think of quality as like old school mature companies. But if you actually look under the hood of most quality ETFs right now, you're going to find Microsoft, Apple, Nvidia, those types of companies that are major players in technology. And with technology, usually a sector that's in favor when the market has a risk-on mindset, it's benefiting quality in this particular cycle. Also wanted to point out that I taught my question and answer session for my premium members earlier here today. So we had another great 3-hour session there. We had a conversation about RNG. Some of you that were in my class here yesterday heard me talk about Ring Central, and decided that this morning when it popped back up again, I decided to take our profits in it. And I'm glad that we did, because I didn't know it at the time, and some of you saw the telegram go out already before this class started. Remember, this class starts earlier than my other classes as well, so I actually had to get that trade done in the first half an hour of the trading session today before I got into this class a half hour after the market opened. But anyway, decided to shut down the RNG trade, because we ended up getting some profits out of it when we were very close to getting stopped out at max loss just a week ago. So I kind of felt like it's best not to look a gift horse in the face. Let's go ahead and take that opportunity to get get a gain when it looked like we were going to get a loss. And I'm very glad that we did, because when I sold it, it was above 54 this morning, and when I looked at it at the end of the day, it had gone down there closer to about $50. So whether that ends up being a good decision a week from right now, I don't know, but after one day, I am glad that I made that decision on behalf of the class. So if you want to hear me talk about that a little bit more in length, feel free to check out the recording there. I spent about 8 minutes talking about that situation there. We also had a question about how to get a Value Line library pass from some guest passes throughout the United States. Also had a question about looking at Dow Chemical as a dividend growth investing candidate, which it doesn't have a whole lot of dividend growth, and therefore it probably didn't do all that well under that context, but talked about some of its history and also its combination and then eventual split up with DuPont and how we think about the different elements of their business model as dividend-focused investors. Also got a question about looking at National Fuel Gas as a dividend growth investing candidate. Got a question about Network Appliance and Omnicom as a couple of companies that haven't raised their dividends recently but remain on their annual streaks, and how to account for that moving forward. Also got a question about how to think about 529 plans for saving for college expenses for children or grandchildren. Got a question about how to use the quick access bar on Microsoft Excel. I got a question about my thoughts on rolling sold puts if the puts would still remain in the blue area of the dividend stair-step chart, and we use Texas Instruments as our example there. And then I got a question about Intel as a long-term investment in the dividend growth investing realm. So anyway, if any of that commentary or content strikes your fancy and you're already a premium member of Market Scholars, feel free to check out that recording. It is now posted there in our Trading Rooms calendar. And then also David taught his portfolio management with ETFs class earlier today. And then tomorrow he'll be doing his technical analysis class. So make sure you're on the lookout for that as well. All right, let's go ahead and pop back on over here to the main part of the Thinkorswim platform and do some more charting analysis. Let's go ahead and take a look at some 12 grids now, starting with chart 5A. This is our asset class 12 grid. And as you can see here, we've got a healthy mix of green and pink charts, as we typically do with this first set of 12 grids, since it does cover such a wide variety of different asset classes out there. And if I had to say there was one major story here today, I would actually say it was interest rates here today. I don't think it got talked about a whole lot. Then again, I was busy in class for 3 hours today, so I'm not sitting around just listening to CNBC or whatever during that time. So maybe they were talking a lot about it. But nonetheless, be aware that we did have a big move in yields here today. TNX was up quite a bit to end the day at 2.88%. And so we're kind of approaching that important psychological 3% yield level once again on the 10-year Treasury yield. And not only was it a big move just in general today for interest rates to be surging higher, but it was an important move from a candle perspective as well, because as you can see, we actually closed back above that falling 30-day moving average, and we closed near the highs of the session there. So remember when I was with you on Tuesday, we were talking about the idea that the assumption is that if we get a continued push, that moving average will act as resistance. Well, so far that is not proven to be the case, but of course we only have one test of that so far, so who knows, maybe tomorrow it bounces right back down. But right now, just wanted to point out that was a pretty aggressive up move in interest rates there, and of course that has reverberations across a lot of different markets, but in particular, bonds usually suffer on a day when interest rates are up a lot, and that's exactly what we saw today. Take a look at TLT get whacked here today. It was down 2.33%. That's your long-term U.S. Treasury ETF, and you can see that it kind of is like a Rorschach test more often than not, where when one of them, in this case the Treasury yield, goes up over its 30-day moving average. Notice the exact opposite happens here with the actual bond prices themselves. Today was a day where you crashed through the moving average on TLT. That was a pretty aggressive move. They're not perfectly one for one because remember the 10-year U.S. Treasury yield is probably a little bit better fit for like IEF, I think is the ticker symbol, where you've got more of your medium-term treasuries there. And there you see that it was just barely below the moving average there. But on TLT, which kind of gets into that 20 to 30-year bond range, it was a more aggressive move, right? There's a bigger move that happens the longer the duration, all else being equal, and we certainly saw that today. So TLT got hit pretty hard here today. Obviously, you're still in the middle of a range in the last 3 months, so it's not like we're having a major breakdown to new multi-month lows or anything like that, but it does call into question whether this bond rally can continue or not. You'll notice that foreign bonds also got hit pretty hard today. They were down about 0.5%. However, notice how far away you are from breaching that 30-day moving average there on foreign bonds. You got a long ways to go. Same thing goes for high yield bonds. You had a pretty aggressive reversal here today where it was down over 0.5%, and you can see a pretty aggressive bearish engulfing candle that existed here today as well, where you kind of gapped up to start the day and then closed at the low of the session, engulfing that prior day. So it's not a very good look for it there, especially since you didn't quite break to new highs from a multi-month perspective that are still in place from back here at the end of May. So we'll see where that takes us. But the good news, if you're looking for it in the high yield bond market, is despite today's give back, you still have a strongly bullish posture. Notice that these other two charts are now weakly bearish. So because we had such an aggressive move higher on the high yield bonds, it can afford to give back a little bit more on the sell-off days and retain its posture for the time being. So kind of a volatile day there for bonds and interest rates today. Another thing that I would point out is that gold and oil kind of had some divergences today once again. Remember, that's largely been the case here recently, where it seems like gold had been doing better than oil, and today was the reversal of that. Today, gold was down, oil was up nicely. When you look at these charts, you can see that both of them are now above a falling 30-day moving average, but the background colors of the charts are slightly different. Gold still has that strongly bullish posture, whereas oil is only at a weakly bullish posture. So it's a little bit harder to trust the oil chart at this exact moment in time, as you had this other day back here where you had this long upper shadow, somewhat similar to what you have today, where it tried to get above the moving average and then it failed the very next day. So could we be setting ourselves up for that possibility as soon as tomorrow? Who knows? We'll just have to keep our eye on it. So with gold, you've got more separation between where it's trading right now and its 30-day moving average. So even if it does have a give back, let's say in the next month or so, there's a better chance than not that it's going to start stabilizing around that moving average. And so knowing what we know right now, there's probably a slightly better chance that gold can kind of work its way out of this downtrend than the odds that you would put on oil. But things change very, very quickly. Of course, oil is pushed around from geopolitical news much more so than other commodities and much more so than other stock markets and things like that. So you just never know when some bomb goes off in some part of the world where it shouldn't go off and oil prices just spike tremendously, right? We hope that doesn't happen, but we just have to account for that possibility when we're dabbling with that kind of a market. The US dollar has been interesting lately as well. Notice that the dollar was just up barely today, but the big story is what happened yesterday. And I'm sure David probably talked to you about that at that time when he did his video yesterday. But yesterday was a big drop off in the dollar. Remember how I was talking the day before about how the dollar had just been riding this moving average and we're waiting for a move one direction or another. Well, we got to move, and if you're to believe the move that it went in, it went down, and so I don't know if it's going to hold it, if it's going to retain it, but right now we have to assume that that was a broken support level there on the U.S. dollar, and if that's the case, then you might start to see a little bit more outperformance in, let's say, the foreign stocks that are out there. Today that was a little bit of a hit and miss concept. SPY, as I mentioned before, was flat. EFA, which tracks the foreign developed stocks, was down just barely. You could basically say that EFA performed in line with the S&P 500, whereas EEM actually did have outperformance. Notice that the emerging markets were up 0.4% today. Now, again, it's kind of similar to what I was saying about RSP, where, it's good to recognize that, but let's not get carried away with it as well, because you do see that long upper shadow, and that could very well leave a pretty ugly mark on the chart, depending upon how things shake out from this point forward. But what we do know at this exact moment in time is that we did have a reasonably healthy advance out of EEM today on a day when, the dollar really did not recover from yesterday's huge tumble. And it was also a day when the S&P 500 went exactly nowhere. So you had a little bit of outperformance there out of EEM. We'll see if that leads to anything. Right now, I'm not going to assume that it is going to, but it's something that I want to keep my eye on and at least plant those seeds for you guys to be on the lookout for moving forward. Let's go ahead and now take a look here at our Sector 12 grid. And as we're looking at that, you can see here we've got mostly green charts in the United States. Now remember, these are market cap weighted charts, and so that plays a little bit of a role here as well. But at this moment in time, we have just 3 charts that are in the pink. We've got communications up at the top. Remember, that's where Disney was here today. So Disney helped the communications actually close in the green today, but you did close well off the highs. And even Disney was well off the highs. I think in the pre-market, Disney was at like 123, and then it closed down there closer to 117. So still up tremendously from yesterday's close, but giving back a lot of the early morning gains that people thought they had in there. So anyway, communications starting to make a more healthy move here, I would say, in the last 2 weeks, but still got work to do. You can see that we're still below the highs that were set in the communications sector back here late May, early June, whereas with the S&P 500, we're above that resistance area. So, it is lagging to a degree, but I don't mind the stabilization I'm seeing here out of communications. It feels healthier here right now. We'll just have to see if the individual stocks will comply, right? We've got other things going on there, like, I talked about on Twitter yesterday about how Facebook/Meta was doing their first major bond offering. Remember, they were once debt-free, no longer the case. So they've got their own unique challenges with dealing with advertising and then also building out the metaverse. And then you've got Alphabet that I mentioned in the video on Tuesday, which might be subject to a lawsuit from Justice Department or other entities that suggest that they are in monopolistic territory. So we don't know where that leads. And those are, of course, a couple of the most important communications companies out there. On the bottom rung here, you can see a couple more pink charts. We got healthcare and we got consumer staples. Healthcare has really struggled from the mega cap pharma perspective here recently. I don't know if you guys have been following that story with Zantac, but stocks like GlaxoSmithKline and AstraZeneca have really got hit here lately. And even Pfizer and Bristol Myers Squibb have been struggling on a relative basis here lately as well. So that's kind of putting a lid on that. A lot of biotech stocks are still doing fine, but it's the major pharmas that are really forcing the sector as a whole to kind of stay in its shell and not really break out the way that we're seeing with some of the other sectors out there. So keep your eye on that continued story there. And then we've got consumer staples that are also in the light pink territory with a weekly bearish posture there. Again, look at the movement, which is largely just sideways in consumer staples over the last week and a half. Whereas when you look at something like utilities right next to it, utilities are going straight up. Real estate has been going straight up. Energy has been going straight up in the last week. Materials straight up. Industrial straight up. Financials, like I mentioned before, I've been impressed with the strength in the financials for the last 3 days. Look at those moves. We've had continued gaps in the financials there, so don't fall asleep on that story. So, we're seeing that on a comparative basis. Staples have largely just gone sideways for a week, and we've seen a number of other sectors that have gone up and advanced at a very healthy clip over the past week. So, when we're looking at these other green charts now, one way to distinguish them is to look at which ones are closer to their multi-month highs. And from that perspective, you could put technology on the list, which hit a new 3-month high here today before selling off into the close. We could say the same thing about discretionary. It touched a new multi-month high on an intraday basis here today. Industrials, you could also put into that conversation. And unlike the other two that I mentioned, industrials actually still closed higher. So they were up by 0.5% today and advanced to a new multi-month high on an intraday basis. So new closing high, new multi-month high on an intraday basis for the industrials. And then you could also probably put the utilities in that category. But similar to technology and discretionary, utilities did close barely lower by 0.01%, so call it flat. But those are kind of the leading areas right now. And it shouldn't be a surprise to those of you that listened to my presentation on Tuesday when we reviewed the sector selector, because remember at that time, technology was number 1, utilities was number 2, and then you had industrials in there somewhere in rankings number 3 or 4 as well. So those are areas that have already heated up and have continued to see strength push into them. So let's go ahead and get into our trade application example now. And we're going to go ahead and do a bear call spread, so a bearish trade, on one of the stocks in the communications area. Now remember, we already did a bear call spread on a communication stock here a week or so ago on a cable company, and today we're going to kind of go hunting within the internet sector a little bit more, but still kind of stay with that theme that's one of the areas that has been kind of sitting out the rally a little bit more so, and actually has its own bearish posture on a sector level at this moment in time. So let me come on over here and let's just go ahead and pull up chart 3A. The other thing I'm going to mention to you real quick is that the trade I ended up doing today was actually my second choice. The trade I actually wanted to do was going to be a bullish trade on this little known company, ATKR as its ticker symbol, but I kind of like the bullish bounce potential out of ATKR. The problem is I tried to get filled on a couple of different trades. I was attempting to do a bull put spread, so a credit spread, and I also actually tried to do a debit spread with call options, and I couldn't get filled on either one. This one is a very illiquid company, and therefore I waited patiently to try to get filled, and it just couldn't get me filled at the prices that I needed, and so I had to pass on it in the end. But I'll kind of put this one out there as an honorable mention candidate for those of you looking for additional trade ideas. This one looks kind of interesting to me. I like the way that you've got your 3 consecutive higher lows. You've also got a couple of higher highs carved out there. Yes, it's underperforming the S&P 500, but I like the bounce up and off of that rising 30-day moving average. You also have a kind of a nice little, bullish divergent signal down below here on your near-term line, that blue line down below. So just to be upfront with you guys, this was the trade I wanted to do for you, but I could not get filled on it. So I had to kind of roll with the punches, so to speak, and pivot on the fly because I was running out of time and there was only 10 minutes left in the trading session. So what I opted to do instead was go to a more liquid candidate and go to the bearish side of the coin, and that was ticker symbol MTCH. This is Match Group. This is a online dating company. They own Tinder and OkCupid and some of those areas. I must admit that as a married man, I don't spend a whole lot of time on dating sites, naturally. So I don't know the ins and the outs of these companies, other than to say that just keeping up on social media and different things like that, that they seem to be some of the more popular dating sites that are out there these days that are controlled by Match Group. The other thing that I would mention real quick is, speaking of their competitor, they have a competitor named Bumble, and as you can see here, Bumble has really struggled. They've really stumbled. Bumble has stumbled here in the last 4 days, as they were putting in a new high as recently as August 8th, and now have had 4 straight down days, which kind of saw that earnings were reported along the way, where they reported maybe a surprise loss there. And now you can see that Bumble appears to be breaking important support levels. So whether that leads to anything major or not, I don't know. But what I can tell you is that that probably doesn't help the cause of those online dating sites that are out there. MTCH looks a little different than Bumble, because MTCH had been in a downtrend for quite some time, whereas Bumble had been in more of an uptrend that has recently been stumbling. This is more of a continuation to the downside here. So what I did here today was just a simple bear call spread, and I think the strike was 72.50 that I sold, and I bought the 75s, and we were able to get like somewhere close to 60 cents for it. If you wanted the exact details of the trade, remember, if you're a premium member of Market Scholars, all that information is listed for you in our Telegram channel, because we post our trade ideas as soon as we do the trades. And so that way it gives you guys a little bit of time to think about whether you want to consider the trades for yourself as well before the market closes, whereas everybody else who just watches the free videos on YouTube, they have the disadvantage of having to wait until the next day to place a trade if they so desire. So anyway, this one got done. Some of the motivation behind the trade is, you can see that we've had a lot of long upper shadows here recently, not only today where it looked like it was going to go up a whole bunch and then basically gave back most of the day's gains. That same thing happened yesterday, and that same thing happened over here on August 8th as well. Notice that the moving average line stayed red that entire time, telling us that price remains below a falling moving average. And of course, this one really laid an egg on their earnings announcement. In fact, I think we talked about it that day. That was one of the days that I was kind of rattling off a whole bunch of those earnings announcements and some of the movements in the after hours session. And so when this company reported earnings, take a look at that massive gap lower. Now, it recovered a lot of those gains and nearly filled that gap, but the question is, do you have enough energy to actually kick this into another gear higher, right? It's kind of the same conversation of what I shared with my students here earlier today on Ring Central. It's the same thing where you had this big drop off, and yes, you have to respect it for the immense move off the lows, but because it exerted so much energy to get off the lows, what are the odds that it can keep on pushing? Now, anything's possible, so that's why we have defined risk with this trade, right? The reason that we're not just selling a naked call and instead doing a bear call spread is because part of the bear call spread is the ownership of another call on top of it, and therefore if things went crazy to the upside or it got a buyout offer or something like that, that we are protected the further it goes up. And so that's a big part of what we do as well, is understand risk management when it comes to these various trades that are out there. So anyway, about $73 or thereabouts would be where our break even would be on this trade if you'd factor in the credit that we received up front. So that's about right here that I'm circling with my mouse. So it's not necessarily something that's an obvious layup type of a trade, but it's an opportunity for me to add another bearish trade into the market where you've got an underperforming security just in case the market does start stumbling once again, heading into kind of the more choppy fall time period. Remember, oftentimes September and October are tough months for the stock market. And so we'll see if that follows through again this year. And if it does, then it'll be helpful to have a few bearish trades thrown in there with some of your bullish ones that have advanced off the lows in the last month and a half or so. Okay, so that's what I had for you here today. Bear call spread on Match Group. If you enjoyed the analysis of the video here today, I ask one simple request out of you. Click like for me there on Twitter. Remember, there's 4 different ways you can accomplish that. You can either do it directly on Twitter, where David and I typically will pin our Market Outlook video to the top of our timeline to make it nice and easy for you guys to find. Otherwise, you can also find the tweet in question directly below the video that you're watching on our website, because we have that little Twitter widget below the video area. You can also find the tweet in question if you're watching directly on YouTube by going down into the description area and then clicking on the hyperlink next to the Twitter area of the description area. And then you can also find the tweet in question by looking for the little Twitter icon on the email notifications that we send you guys as well. So there's 4 different ways. They all take you to the same spot. So however you choose to do that, we'll leave up to you. But if you want me to do another full-length video, including a trade application example when I'm scheduled to do the video again on Tuesday, then as long as we're up and over 100 likes, I'm happy to do that for you. If we're under 100 likes, then I'll just stick with a typical 15-minute review of the indices themselves with no trade application example. So I'll let you guys decide that collectively, what you prefer from that perspective. But David should be back with you tomorrow with his video as well. And I want to wish you all the best of success with your trades and your investments. And I hope you all have a wonderful weekend as well. Take care, everybody. Bye-bye.